SPY. And when we go to the, the calculator, Rob, thank you for the question. But we go to the options chain. And these options expired, so let's come out a little bit further. So this is the options chain from yesterday's close. We're not open yet. So the April 22nd is already expired options. So let's go to April 26th, and we're just going to pick up. Let's do a call, right? And here I'm on April 26th options expiration, and we have the calls to the left, puts to the right. And when you click on the bidder offer like this, it'll pop up a options profit calculator. So you could do a call spread, straddle, whatever it is, but let's just stick with, to make it simple, we queued up this April 26th 500 call in SPY. So if we run analysis, what it does is create this initial summary view, where we have this is the price of the option, with the bid and ask next to it, midpoint. These are the theoretical values that Rob was referring to. And then you have some graphs here, payout diagram graphs. This is what the option did yesterday, and the risk sensitivity. So with the theoretical values, what we're doing is, one of the analysis is say, okay, here's this option. And this is the market price. So we see the market price here, 336. Right. So think about it as, you go out there and try to buy investment real estate property. Well, the market price, there's people offering it for sale. But before you buy, you want to kind of do an analysis and say, well, what do I think it's potentially worth? Right. So you start running it through a model. What is it worth based on how much rent I could get, how much, other places sold for, what are my maybe projections. So you come up with this theoretical value as a benchmark to try to see where the market is versus where you think, this could be worth. And so here we created two theoretical values for you to start out with. So this is a baseline, right? One is, well, what do we think this option is worth based on how historically the stock behaved? Right? If we took the return distributions of the stock and ran them through a model, what do we think it's worth? And then the other theoretical value is, we could look at historical option prices for similar options and figure out what do we think it's worth if we use that methodology, right? The implied volatilities and so forth. So here we gave two base models to start out with. There's no one correct or exact model. We're using different datas and assumptions in each one. So this one happened to be, they were both equal. Now we came up with this baseline average price. Okay. But that's the average price. Well, what we know is that you have a lot of data, and based on which data you're inputting, you're going to get a different output. So let's go to the historical return distribution here. And over here, this is the theoretical value. This is the current price. So we see that the current price, if you're buying it, right, the theoretical value is 17 cents below. So it's like, if we took the average price, the market price is a little bit above that. by 17 cents. And then another question would be, well, if we're buying it for $3.36, then there could be observations above that. The stock could have moved, high enough historically. We have it set to 4 years. Could have moved historically, high enough that it would exceed the 336. All right. So our question is, how often did that happen? So that's what we call the win rate. How often did the stock go up by a big enough percentage given the same circumstance, given like 4 days to expiration, the stock this is the strike price, this is the premium. How often did the stock increase by big enough percentage to cover this premium and be profitable? Right. So we're looking at all those observations. And if we looked at the data, it says that was 33% historical win rate, 33%. Okay. So 33% of the time, here's the data below. The stock, these are historical, these are the stock changes, right? And this would be where if it does it again, these are the prices of where SPY would close at, and this would be the theoretical value of that option. And in our observations, out of 126 in the last 4 years, that happened 33% of the time. Okay, 33% of the time, it exceeded that percentage. And if we took the data and then looked at, put it into percentile ranks, right? So over here, I could just sort it by highs to lows. So the best, if it replicated the best moves from historically in the last 4 years, it would be worth $17. Second best, 16, 15, 40, right? So let's take a percentile over here and look at it. And historically, if I translated what this option historically, if we sorted it from highs to lows, it says that the top move, based on the top move, the max move, this option would be worth $17. In other words, all our observations, theoretical values, 100% would be below 17 or below. All right, so we didn't have any $18, $19, $20. Based on these 4 years of data, 17 was at the top, the highest value. So then we break it down into 4 quartiles. What about 75% of the observations? So 75% of the observations were below $5.39. So what that means is the top 25% were between $17 and $5.39, but 75% were below $5.39. Okay. What about right in the middle? So 50th percentile, half of them were above, half of them were below. That was 22 cents. Okay. So half the observations were below 22 cents, half the observations were above 22 cents, which makes, that means it just didn't go up enough. If the stock was down, they expired worthless. If the stock was up but didn't reach the strike or was below what the strike plus premium, it was unprofitable. So 50% of the time, the observations were below 22 cents, 50% above, and 25%, they're all, zeros. So this gives us a breakdown of that historical data. So now we have a picture, okay, on average, if we took the average of all our end values, right, all of these end values, those $3.19. But how was that distributed? So here are all the values, a histogram of theoretical values, how these were distributed. And you could see here's the red line. So this is where the market is right now, $3.36. And based on that red line, we could see how many theoretical values were above it. So these would be the ones that would be profitable, because if they ended higher than 336, then it would be worth more at expiration, right? If it's lower than $3.36, it would be unprofitable because you would get less back than you paid for. If we assume $3.36 is the premium we're paying, then these are the ones that would be unprofitable. And here is zeros. So we could see a big portion of them were zero. Or I'm sorry, this is between negative and 80 cents. Sorry, so this isn't exactly, these are ranges. Okay, so these are ranges. So this is below 80 cents, 0 to 80 cents. So a big portion of them is right there. And you could see here, 9.5% were between 251, 337. So if you hover over it, you kind of get this distribution of different values. And if we plot right there where the market is, you could see to the left of it and to the right of it, right? So to the left of it is the times that it would have been unprofitable. To the right of it, times it would have been profitable. So when we talk about win rate, 33% of the time, that would have been all these would have been a win. And you could see that these are all over the place. So it could be between $4.22 and $5, but you had some big ones out here. One observation around 17, one observation between these two. So this is what the distribution of the theoretical values would look like if we used historical data. Does that help?
Rob, let us know if that helps.
I might change this view. Maybe it's not as intuitive. So I'll see if I could perhaps change this view to make it more intuitive, that's what's going on.
Rob did say thanks for the explanation. So there you go.
Yeah. All right. Thank you.
We did have another, I don't know, we have about 10 minutes left. We had another question outstanding from Rob yesterday, was asking, is there any way to calculate implied moves prior to the next day after closing of the market? Or does that final implied move indicate that somewhat? I guess when it's based on where the straddle closes in, so it has to be closes. There's no way to do it after hours, right? There's no trade.
Right. So the implied moves. So these are I think this is the tool that this question was referencing. And when we just to describe what's going on, first of all, anybody who doesn't understand this, here we have this bar going up and down, okay, around 0. And what that bar is shown is based on the previous day's closing options markets, right? We take the implied volatility of the nearest expiration before, the closest. If there's a 1-day expiration, we look at the 1 day. If there's 2, 3, 4, 5, whatever it is, we look at the nearest expiration, and we look at the implied volatility of at the money, and based on that implied volatility, we calculate what is the implied daily move, implied 1-day move. Okay, up and down. So that's what the implied volatility does. It tells you the implied average daily move, up or down. So the bar is showing you up or down. This is what the market implied at the end of the day, at the end of like a full trading day. This is where it closed. And then we capture that, we store it, and then we compare it to what actually happened the next day. So over here, we see that based on the previous day's close, the market was implying a move of plus or minus 1.1%. The actual move was 0.9%. Okay, so the actual move was a little bit below the implied move. This is why the green bar is telling us the move was up, and it was within that straddle range. So what does the 1.1% means? That if it moved exactly up 1.1% or down 1.1%, well, that's where the break even is, buyers and sellers, right? And here we get a visual going back like a month of the implied moves versus the actual end of day moves. And then we have these stats here, how many times it was within range, how many times did it break out, like over here, where the move went beyond the implied move. And the question is, well, can we get an implied move for the next day before the end of the day? Was that it? Well,
Yes.
so we could, it's coming. So the implied move is coming from the options markets, right? The options implied moves are constantly moving with the markets, just like the stock is moving around. So all day it could fluctuate up and down. And it also reflects the day, the volatility expected on the remainder of the day too. So we look at it as, at the end of the day, where did the options go out? Because at the end of the day, that entire days of trading is done, and the options are basically forecasting future volatility going forward to the next day. So that's why we use end of day implied volatility. Where did it close after full days of trading, and then what did the market do the next day?
All right, D, that's very helpful. Thank you.
Yeah.
There are no other questions popping up. Rob did say yes, it was that tool. So awesome.
All right.
All right. Well, we're right. We got about 5 minutes left. Anything else for the chameleons before we go?
No, I think I'll just end it here, so I don't jump to any, and start up a new tool. But yeah, everyone, thank you for joining. Stay safe out there. Have a great trading day, and hope to see you guys tomorrow.
Yeah, great job, D. Thanks so much. Great job with the questions, Rob. Thanks to the chameleons for joining. Everyone have